Hello everyone, and welcome to our quarterly macro update where we cut through the noise and get right to the meat of what's driving this market. I'm your host, Jeff Manga. I'm one of the partners here at 6 Degrees. We specialize in financial and information technology staffing and consulting. It's been quite an interesting couple of months in the financial world. The media loves to shock and scare you, and sometimes it's hard to understand what's actually happening behind the scenes. It is important to look at key indicators to comprehend what is actually going on. A logical approach to understand the market is to break it down and consolidate financial data into a macro format. And that's exactly what we're going to do today. This is my take. We're going to roll up our sleeves and dive headfirst into the numbers that matter. If you like the video, be sure to check out our firm on the net at 6degreesinc.com. Follow us on LinkedIn and subscribe to our YouTube channel. We would love to have you. Let's jump in. The economy is changing hourly, and you need the best intelligence to navigate it. Let's get into it. We've got a jobs report that's throwing curveballs, a Fed that's keeping us all on the edge of our seats, and a monster bill coming out of Washington that could change the whole game. You can't afford to be sitting on the sidelines waiting for someone else to tell you what to think. You need to be informed, you need to be ready, and you need to be decisive. So grab your notebooks, turn up the volume, and get ready for a lightning round of pure, unadulterated market analysis. We're going to break down the 7 biggest macro stories moving the markets right now. No fluff, no jargon, just actionable insights to help you make sense of the madness. Are you ready? Let's ring the bell and make some money. Ski-daddle. First up, let's talk jobs. The latest report came in, and bam, 147,000 new jobs. The so-called experts were scratching their heads. They were expecting a slowdown, but this market keeps defying gravity. And get this, the unemployment rate is ticking down, not up. This isn't just a number, folks. This is a story. It's a story of a resilient American economy that refuses to quit. People are finding work, they're earning money, and they're spending it. That's the fuel that powers this economic engine. And right now, that engine is roaring louder than a freight train. But you have to look deeper. Why is this happening? It's not just a cyclical bounce. We're seeing real structural shifts. The boomers are retiring, leaving a huge gap in the workforce. The pandemic changed how and where we work, creating demand for new skills and new roles. This isn't your grandfather's labor market. It's tighter than a drum. Companies are fighting tooth and nail for talent, which means they have to pay up. That's wage pressure, and it's a double-edged sword that we have to watch like a hawk. So what's the takeaway here? Don't bet against the American worker. This tight labor market means consumers have staying power. It means the foundation of the economy is solid, even if the headlines try to tell you otherwise. But it also means the Fed has a real headache, which we'll get to in a minute. The bottom line is this. The jobs picture is strong, almost too strong, and that strength is the single biggest factor sending shockwaves through every other part of this market. You ignore it at your own peril. Don't fight them. All right, that blockbuster jobs report leads us straight to the temple of finance, the Federal Reserve. Everyone and their brother was screaming for rate cuts. Cut now, cut deep, they cried. Well, guess what? With a jobs report this hot, a rate cut in July is off the table. Forget about it. It's gone. Jay Powell and the gang cannot and will not cut rates when the labor market is this tight. To do so would be like throwing gasoline on an inflationary fire. It would be irresponsible. And these guys are anything but. Think about it from their perspective. Their mandate is stable prices and maximum employment. Well, they've got the employment part in spades. It's the inflation beast they're still trying to wrestle into its cage. They've made progress, no doubt, but cutting rates now would signal that the fight is over, and it's not. They need to see a sustained period of cooling, not just in the headline numbers, but in the wage data, too. That jobs report was a signal to the market. Don't get ahead of yourselves. The Fed is on hold, and they're going to stay there. So where do we go from here? All eyes are now on September. That's the next big meeting where a cut could even be a remote possibility. But even that is not a slam dunk. We need to see the inflation data come down. We need to see the labor market soften just a little bit. And we need to listen to every single word that comes out of the mouths of the Fed governors. They are telling you their game plan. Don't fight the Fed. They have the power, they have the tools, and right now their finger is hovering over the pause button, not the cut button. Now let's talk about the big greenback, the US dollar. For months it was the king, the undisputed champion. But look at it now, it's down 11% year to date. That's not a dip, that's a dive. A veritable swan dive off the high board. Why is this happening? It's simple, folks. The rest of the world is getting its act together. Other central banks are still in hiking mode while our Fed is on pause. That interest rate differential, the gap between our rates and theirs, is shrinking, and that makes the dollar less attractive to foreign investors. Money flows where it's treated best. This is a massive shift in the global financial landscape. For months, a strong dollar was a headwind for our multinational corporations. Every dollar they earned overseas was worth less when they brought it home. Now, that headwind is turning into a tailwind. A weaker dollar means that profits from Europe, from Asia, from everywhere get a nice little boost. It makes our exports cheaper and more competitive on the world stage. This is a huge, often overlooked positive for the S&P 500. But hold on, it's not all sunshine and rainbows. A weaker dollar has a dark side. It means imports get more expensive. That car part from Germany, that bottle of wine from France, that smartphone from Asia, they all cost more. That puts upward pressure on inflation, the very thing the Fed is trying to kill. It also means our trade deficit could get worse before it gets better. So we've got this tug of war. A weaker dollar is great for big American companies, but it could reignite inflation. This is a delicate balancing act, and the direction of the dollar is a story you have to follow every single day. Let's turn our attention to Washington, where they're cooking up something massive, the One Big Beautiful Bill Act, or OBBA, as they're calling it. This thing is a monster. We're talking sweeping tax cuts for the middle class and for corporations. We're talking about powerful incentives to bring manufacturing back to our shores. And we're talking about a fire hose of stimulus aimed squarely at infrastructure and technology. This isn't just tinkering around the edges. This is a full-blown attempt to turbocharge the American economy into the next decade. It's a bold, audacious plan. The idea here is simple. Put more money in the pockets of consumers and businesses, and they will spend it, they will invest it, they will hire people, and the whole economy will grow. It's classic supply-side economics on steroids. The proponents are screaming that this will unleash a new wave of innovation and prosperity. They believe the growth generated by these cuts and incentives will be so powerful that it will ultimately pay for itself. It's a beautiful theory, a symphony of economic optimism that promises a brighter future for everyone. But here's the rub, the big question mark hanging over this whole thing, the national debt. How do you pay for the biggest tax cut in a generation when you're already sitting on a mountain of debt? That's the trillion-dollar question. The math is tricky. You're betting that the economic growth will be so spectacular that it boosts tax revenues enough to offset the cuts. It's a high-wire act without a net. If they get it right, we could see an economic boom like we've never seen before. If they get it wrong, we could be looking at a debt crisis that makes our current problems look like a walk in the park. This bill is a game changer, one way or another. Remember the tariff terror? For years, every time the word tariff was mentioned, the market would have a heart attack. The VIX would spike, the Dow would plunge, and the talking heads would predict the end of the world. Well, I'm here to tell you that the game has changed. We just got news that the next big tariff deadline has been extended. They're kicking the can down the road again. And you know what the market did? Nothing. A big fat yawn. The fear is gone, people. Why the change in attitude? Two reasons. First, we've been living with this for years. The market has priced it in. Companies have adapted. They've rerouted their supply chains. They've negotiated new deals. They've absorbed the costs. It's not the terrifying unknown it once was. The policy shock has worn off. It's like a horror movie you've seen 10 times. The jump scares just don't work anymore. The market is looking forward, not backward. Second, the expected rates are coming into focus. We're not talking about the crazy 50% numbers that were thrown around in the beginning. The chatter is now around a much more manageable 10 to 15% on specific goods. Is it good? No. But is it a market crashing catastrophe? Absolutely not. It's a manageable headwind, not a hurricane. The market has bigger fish to fry right now, like the Fed, like the dollar, like the OBBA. The tariff story has moved from the front page to the business section. It's still a factor, but it's no longer the boogeyman hiding under the bed. The rally roars on. Now for the main event, the one you've all been waiting for, equities, the stock market. Look at the S&P 500. We've had a 25% rally since the lows in April. 25%. While the bears were hiding in their caves, predicting doom and gloom, we've been riding this bull for all it's worth. This isn't a fluke. This isn't a sugar high. This is a broad-based, powerful rally that is telling you something very, very important about the health of corporate America. This is the big leagues. So what's lighting the fuse on this rocket ship? It's a perfect storm of positive factors. First, earnings have been spectacular. Companies have proven they can maintain their margins even with higher costs. They are lean, mean, profit-making machines. Second, as we discussed, the weaker dollar is providing a nice tailwind for our multinational giants. And third, there's a growing sense of optimism that the Fed is done hiking and that the economy will achieve that magical soft landing. Money that was hiding in cash is now flooding back into the market, chasing performance. What's the outlook for the rest of the year? I'm telling you, I think this bull has legs. The second half of 2025 could be even better. We have the potential for rate cuts later in the year. We have the potential stimulus from the OBBA, and we have investor sentiment that is finally turning from fear to greed. Of course, there will be pullbacks. There will be volatility. The market never goes up in a straight line, but the underlying trend is strong. The path of least resistance is higher. You don't bet against a trend like this. You ride it. Finally, let's look at the plumbing of the financial system, the credit markets. For a long time, this market was frozen. Nobody wanted to lend, nobody wanted to borrow. But now the ice is thawing and the water is starting to flow again. We're seeing a real pickup in credit demand from both consumers and corporations. People are confident enough to take out loans for cars and homes. Companies are confident enough to borrow money to expand, to invest, and to hire. This is the grease that lubricates the gears of the economy. Look at the spreads. That's the difference between what it costs the safest borrowers, the US government, and what it costs riskier companies to borrow money. those spreads are getting tighter and tighter. That means investors are becoming less fearful. They're more willing to take on risk because they believe the economy is on solid footing and that companies will be able to pay back their debts. This is a massive vote of confidence in the future coming from the smartest money in the room. And here's the big move. We're seeing a huge rotation of capital. For the last year, everyone was hiding in safe haven government bonds. Now, that money is pouring out of treasuries and into high-yield corporate bond funds, also known as junk bonds. People are hunting for yield. They are no longer content to sit on the sidelines earning next to nothing. They want returns, and they're willing to take on calculated risks to get them. This flow of funds is another powerful confirmation that the risk-on trade is back in a big, bad way. Don't ignore the bond market. It's telling you the coast is getting clearer. And there you have it. 7 stories, 1 incredible market. We've covered the jobs juggernaut, the Fed's freeze, the dollar's dive, and the massive OBBA bill. We've looked at the fading fear of tariffs, the incredible rally in stocks, and the undeniable thaw in the credit markets. It's a complex picture, a whirlwind of cross-currents, but it's not impossible to understand. The key is to connect the dots, to see how a strong jobs report impacts the Fed, and how the Fed's actions impact the dollar, and how the dollar impacts corporate profits. It's all one big, beautiful, interconnected machine. The road ahead won't be easy. There will be bumps. There will be pullbacks. There will be days when the sky feels like it's falling. But don't let the noise scare you out of your positions. The underlying trends we talked about today, a resilient consumer, strong corporate earnings, and a return of risk appetite, are powerful forces. Your job is not to predict every wiggle of the market. Your job is to do your homework, understand the big picture, and invest in high-quality companies that can thrive in any environment. Stay disciplined, stay informed, and never, ever stop learning. This is where the real work begins. The market gives you the information, but you have to decide what to do with it. Knowledge is power, and right now you are more powerful than you were 10 minutes ago. So, I want to hear from you. What concerns you the most about these macro trends? What opportunities do you see? There are no bad answers in this house. Let us know in the comments. Until next time, I'm Jeff. Go out there and make some money. Booyah!